The card comes out of the wallet at the register and nothing happens. That is the whole trick. No number appears. No warning light. Just a small green checkmark and a receipt. Somewhere behind that checkmark, money already changed hands 3 times before you got your 2% back. My name is Horizon, and I read the footnotes on payment network filings so you do not have to. Right now, there is a man named Marcus standing in a Kroger parking lot in Ohio, watching his statement balance. There is a woman named Priya 3 states away, boarding a flight to Lisbon that she is fairly sure she paid nothing for. They use the exact same card. One of them is being subsidized. The other one is the subsidy. Here is the sentence that should be on every rewards card: someone has to pay for the 2%. Cash back is not a discount. It is not a loyalty gift. It is a redistribution, engineered on purpose. So let's take the card apart. Not the app, not the annual fee, not the sign-up bonus you have already memorized. Pathway 1, the swipe. Every time a card is used, the merchant does not keep the whole sale. A slice comes off the top before the money ever reaches their account. That fee is called an interchange fee, running between 1.5 and 3.5% of the transaction. Premium rewards cards carry the highest interchange rates in the entire system. That fee is not paid by the cardholder. It is paid by the merchant. Every merchant. Every card. Merchants raise prices to cover interchange costs before you ever see the shelf tag. Cash and debit customers end up paying the same elevated price as the rewards customer, without receiving any of the rewards. The price of the milk goes up for everyone. Only some of everyone gets points back. Pathway 2, the float. Priya pays her statement in full every single month, on autopay, without exception. Priya is what the industry quietly calls a transactor. She uses the bank's money interest-free for 25 to 30 days, pays it back in full, and collects rewards the entire time. That interchange revenue is the pool the rewards get paid out of. If every cardholder in America behaved like Priya, the rewards economy as currently priced would not survive. Someone else has to be generating the actual profit. And that brings us to Marcus. Pathway 3, the revolver. Marcus carries a balance. Not recklessly, there is always something. A car repair in March. A dental thing in June. Back to school in August. The balance never quite clears, and it rolls, month after month. The average interest rate on accounts that carry interest sits above 22%, higher on rewards cards. A $4,800 balance at 24.9% takes Marcus past 17 years to pay off. He pays more than $6,900 in interest alone before the balance clears. That card also happens to be earning him 1.5% cash back on every purchase. Marcus is earning roughly 1.5 cents on the dollar. He is paying roughly 25 cents on the dollar. That is an interest product wearing a rewards program as a costume. According to the CFPB, revolvers generate the overwhelming majority of issuer interest income. Issuers model revolver behavior explicitly when designing reward structures. Marcus is not funding his own rewards. Marcus is funding Priya's. That is not a metaphor. That is the accounting. Pathway 4, the ones who never had a chance to opt in. Roughly 30 to 40% of American adults primarily use cash and debit. That population skews toward lower-income households, spending a larger share of income on necessities. Cash-paying households functionally subsidize card rewards for card-carrying households. The researchers characterized the net transfer as regressive. Households earning under $20,000 transfer roughly $21 annually to households earning over $150,000. It is a small number per household. It is not a small number in aggregate. Nobody in that chain is doing anything illegal. It is just what the structure produces. The part where I try to talk you out of feeling smart about this. Being a transactor is not free. It requires cash flow buffer. Being able to be Priya is itself a form of privilege the reward structure is rewarding. Even Priya's win has an asterisk most people never check. Rewards cards carry annual fees commonly in the $95 to $695 range. The average cash value of a major airline mile sits between 1.1 and 1.5 cents. She did not get a free flight. She got a flight priced in a private currency she does not control. Back to Marcus, because his story is not finished. Marcus is not undisciplined. The emergency in March was real. He is running a household without slack. Behavioral economists found that rewards programs measurably increase spending relative to a no-rewards control. The reward creates a small dopamine hit at the point of purchase. For Marcus, that same nudge increases the balance that then compounds at nearly 25%. The reward is not separate from the debt. The reward is the mechanism that produces the debt. Let's talk about who actually profits, because it is not who you think. The card network sets the interchange rate structure and takes its own cut. Merchants have lobbied for years to cap interchange fees, over a multi-billion-dollar fight. None of these three players is optimizing for Marcus's well-being or Priya's cleverness. So what do you actually do with this? For a genuine transactor, the math is real. You are collecting a transfer already being made. If there is any real chance you might carry a balance, the rewards card is priced against you. You would need to be earning roughly 17 times your current cashback rate just to break even. If your income dropped by 15% for 3 months starting tomorrow, would this card still be paid in full? What Marcus actually did, because the ending matters more than the arithmetic. Marcus did not cancel the card. Canceling can shorten credit history and spike utilization. He moved the $4,800 to a card offering a 0% introductory period on transfers. He committed to a fixed payoff schedule inside that window. That call did not erase the structure, but it took Marcus out of the revolver pool. The reframe, cash back was never a discount. It was never the bank being on your side. It works exactly as designed, for everyone in the chain, all at once. If you are Priya, you are not clever. You are liquid, and the system is quietly generous to liquidity. If you are Marcus, you did not fail. You are the funding mechanism for a product marketed as a benefit. By the way, if untangling structures like this is useful to you, I run a school community. Priya lands in Lisbon, checks in, and genuinely believes the flight cost her nothing. Marcus is still in the Kroger parking lot, looking at an app that tells him he earned $6.40 in cash back. Neither of them did anything wrong. Neither of them read a cardholder agreement closely enough. It is written in a Federal Reserve working paper neither of them will ever open. I am not a financial advisor and this is not financial advice. Every rate and figure here is a snapshot that will shift with the quarter you are standing in. The structure, though, does not move. So the next time that card comes out of the wallet and the checkmark turns green, ask the only question that actually matters: this month, am I the reward, or am I the one paying for it?